Hello and welcome to our latest Insider interview. Today in the studio I have with me Gervais Williams, Fund Manager of the Diverse Income Investment Trust. Gervais, thanks for coming in today.
It's a pleasure to be here.
So to kick off, Gervais, could you summarise your investment approach for the investment trust?
So the trust is an income fund. It's a UK invested income fund. So specifically it invests principally in UK quoted companies, both large companies where a lot of the income is generated, but also including AIM listed income stocks, which often are more immature, which have the opportunity to grow and are often in a wider range of sectors. So the nature of it is it's a multi-cap approach, invested in companies which overall generate not just sustainable income growth, but ultimately better income growth than many others. And it's the combination of good income growth plus the underlying income, which delivers hopefully an attractive return.
So what's the current split between large, mid and small cap? I know that you do have a tendency to prefer the mid and small cap names. Is that the case at the moment?
Yes, the overall position hasn't changed that much. Typically, we have about 40% of the fund in the mid and large cap stocks. So that's the top 350 holdings in the mainstream stock market, which includes about 50 or 60% in the smaller end, including about a third of the total fund in the AIM market. So it's quite skewed towards some of the smallness, but there's still a large number of FTSE 100 companies and some FTSE 250 companies in there as well.
And is it those FTSE 250 and the small cap companies where you're finding the best value opportunities, given that that part of the market's been out of favour for 2 years now, pretty much since interest rates started rising?
Yes, I mean, what's been a very big feature over the last 3 years, really, is that the mainstream FTSE 100 has actually held up extremely well. Indeed, in dollar terms, it is the best performing stock market in the world over the last 3 years versus nearly all others around the world, which is quite a surprise. Compare that with the smaller end of the stock market, the FTSE small caps and the AIM market, which is actually disappointed. And have actually, the AIM markets underperformed the FTSE 100 by over 50% in the last 3 years. So coming back to it, yes, there's lots of stocks further down the market capitalisation range, which are very overlooked, which are standing on low valuations, which have good prospects. But I think that understates the potential for the mainstream FTSE 100. I mean, even the mainstream sort of energy stocks, some of the financial stocks, you can buy some mainstream large cap financials with yields of 8, 9, 10%, sometimes growing their dividends at 5% a year. Not just in the energy sector, not just in the mining sector, even in some of the financials. I think the UK is overlooked. I think small caps are particularly overlooked at the moment.
Could you pick out a couple of examples of stocks that are trading on low valuations that, in your view, are unjust?
Yeah, so if you take PayPoint, for example, it's a company which is involved in all the corner shops when you go and pay for things. They use it as a terminal, but you can use it also to actually pay for your utility bills and that kind of thing. So specifically, it's a very nice company. It's made an acquisition. It's grown its dividend quite happily over recent years. It's yielding about 6.5%. It's grown its dividend at about 5.5%. So coming back to it, that's a very attractive combination going forward. And it's very much what we look for when we meet companies. Another example is probably XPS. It's a company, again, which is involved in the financial sector. It happens to be advising pension schemes. Its yields about 4%, but it grew its dividend about 17%, just under 17% last year. Just fantastic figures, really.
You mentioned you're finding opportunities across the whole market. Are there any particular sectors where you're more wary of investing in, and are there any sectors that are trading on higher valuations?
Yes, we've been quite cautious, really, of the sort of cyclical type businesses, companies which are reliant on economic growth. We think there is an economic slowdown coming. The UK economy itself hasn't come into recession as yet, but may come into the recession in the future. So coming back to it, we're quite cautious regarding some of the cyclical opportunities. On the other hand, we're quite sort of a little bit braver in certain areas which people find uncomfortable. As I mentioned earlier, the energy stocks. Now, don't get me wrong, I think we need to address carbon and energy change. I think that's absolutely essential. But I think that we need to kind of bridge between here and there by using some carbon along the way. And I think some of those energy companies are very overlooked in the UK market, especially further down the market capitalisation range. And I think the same is true in the mining sector. Again, I think a lot of investors say they don't know what the price of copper is going to be in the future and such like. Neither do I, but it's less correlated with the rest of the UK economy, and you can sometimes find it when local businesses are suffering. Some of these mining stocks are continuing to do pretty well. And again, these companies are standing on low valuations, generating surplus cash and generating very good dividends.
And in terms of portfolio activity in 2023, has it been a busier year than usual, given that you're finding plenty of opportunities? And could you name a recent purchase for the trust?
If anything, actually, what we've seen is as the economy has slowed, we've been a little bit more cautious about some existing holdings. So we've, if anything, sold more holdings than bought new holdings. The number of holdings, which is normally about 120, has actually probably slipped a little bit below 120 at the moment. So there's just less companies which are doing well, in our view. But on the other hand, there's still companies which are very overlooked. A good example of that is a recent purchase, which is U Group. It's a utility. It's a bit like British Gas. It really supplies the corporate sector. And the really exciting thing about this is it's tiny. Its service levels are very strong, but it's growing quite rapidly. So here's a company which was valued at less than 20 million about 3 years ago. It's about 160 million market cap now. And you might say, well, that sounds like an awfully expensive company. It's generating cash. Even at the end of this year, according to the stock market forecasts, it's got about 35 million of cash in its balance sheet this year. And at the next December, it might rise to about 80. And thereafter, it might be 106, according to the stock market forecast. And this company is now starting to pay dividends. So we've got into a company moving into cash flow surplus, generating surplus cash, taking market share, and in a very resilient sector. Just the combination we're looking for.
And while it has been a tricky period for mid and small cap stocks, on the dividend front, it's been more optimistic. Could you name a couple of companies that have, performed well in terms of delivering good dividend growth over the past year?
Yes, I mean, the kind of companies we're looking for aren't just in the mainstream sectors. Of course, we're looking at the mainstream sectors. As I mentioned, there are some financials such as M&G, which is yielding 10, and it's grown its dividend by 5% this year. So, some of the life companies have been very good. Some of the insurance companies, again, Saber's another company which doesn't have a big yield yet, but it's been growing its dividend. Very strong results going forward. And then you look into the energy sector, and we have things like i3 Energy there, for example, which has grown its dividend over the last 3 years, much stronger than Shell have done so. It's still yielding about 7.5 on a prospective basis. And if there is a sustained oil price going forward, if they spike up, for example, we think it would grow its dividend considerably faster than Shell going forward.
Thanks for coming in today.
Thank you very much indeed.
That's it for our latest episode of our Insider interview. You can check out the rest of the series on our YouTube channel. Please let us know what you think. You can comment, like. Please do hit that subscribe button as well. And hopefully, I'll see you again next time.